So as Ron said, we'll be going over some things this evening. Agenda for tonight, kind of the same format as we've been doing over the past several months towards the end of last year and the few webinars we've had this year. So first I'll go over the Orange County real estate market. I'll also touch on a little bit of the Inland Empire as well, since Chrissia is not able to join us this evening. And then also I'll be sharing with everyone what legislations we really think you need to know about, some bills that are up for discussion, some that have either passed or been declined. So we'll go over that. Ron will then go over the update more so on the inflation, as we spoke about in previous webinars, and why rent increases are obviously important. And then Ron, as well as John, will share with us a lot on protecting your assets as far as with insurance. And then lastly, I'll be wrapping it up with kind of an overview of the whole rental market, both in OC as well as the Inland Empire. So with that, I'll start us off with the Orange County real estate market. So one of the first things I just want to share with everyone is specifically in Orange County, this is a graph, and you'll see where the arrow is pointing, that's 2022. The other ones go back about 3 years past to 2019, and you'll see the colors are situated with the years. So you'll see 2019, there was a whole bunch of homes on the market and available. And then you go down the list there, 2020, not so much. As we all know, last year, very low inventory, and this year, especially low inventory at the start of the year. Now, as of late April into this month, which is May 2022, it has started to creep up a little bit, and that's really normal in any real estate market, as far as we're getting into the spring and the summer months, so more homes typically come on the market. Kids are out of school, job relocations, things like that. What I really wanted to focus on, though, and this goes for wherever you're purchasing, but as far as interest rates, and I know that we're kind of beating on a dead horse here with everyone, but what we've seen is interest rates, as everyone's probably seen online, on the news, that interest rates are creeping up incrementally, right? But prices are still at an all-time high, and everyone is wondering, well, why is that? Usually if interest rates creep up a little bit, prices tend to go down, right? That would be normal. However, as we've kind of explained in previous webinars, is that the housing shortage, that is what is really driving home prices more than the interest rates, because there is not enough homes for people to buy. Thus, when someone puts their home on the market, that's why you're seeing multiple offers in a lot of cases. And so you'll see on this graph at the end of last year, interest rates were about 3.27% on a $1,100,000 home. Your interest or your payment, I should say, would be just above $4,300 a month. Okay. Now, as of a couple weeks ago, the interest rate was about 5.5%, just above that, and your payment would be about $5,650, round numbers. So you can see on a monthly basis, just from December to now May, in those short months, with the interest rate going from 3.27 up to 5.55, your monthly payment increases by over $1,300 a month, and which equates to almost $16,000 more per year. And so again, if you're in a position and you're looking or thinking of purchasing a property, whether it's to live in yourself or whether it's for a rental property, regardless, is do it now if you can. We know everyone's situation is different, and I know we keep saying this, myself, Ron, and everyone else, but really now is the time, because again, going back to interest rates, even if they go up to 6%, 6.5%, 7% in the next 12 to 18 months, it still will not really have a big effect on home prices, because again, going back to, there's just not enough homes out there. So we're working with a few, several clients at the moment. I know me with one client, their hesitation was, well, we want the market to cool off. And while I can appreciate that, what I just shared with everyone is it's not going to cool off for the foreseeable future. And we're not just talking in the next couple months, we're probably talking in the next couple years. Now, I don't have a crystal ball, but that's just what we're seeing, again, because there's such a housing and shortage in housing, excuse me. Ron, do you want to add anything to that?
Yeah, I just want to, let everybody know that a lot of times you think, well, now I jumped to 5.5, I want to wait until the interest rate comes down. Okay, the idea is just because you go into an interest rate of 5.5 or 6.5, eventually the interest rates will throttle back down. And it's very simple. That's when you do a refi. If you wait to buy the property, okay, let's say a year from now, because you don't want to buy because the interest rates are now 5.5, what you're going to find is that $1.1 million home is now 1.2 or 1.3 million. Okay, that's the challenge you have. So, at least if you lock in the price of the home, the interest rates will throttle back eventually. It could take a year or two. So as long as you can go ahead and afford the monthly payment and have reserves, then you should still consider buying now rather than trying to work the market a year or two from now. Because like Tyler says, you only got a basic supply, and people, and I'll just say this and we'll move on. In 08, everybody quit building for the most part. Okay, well, nobody's really built any significant properties for 14 years. Well, kids that were 10 years old, they're now 24. Okay, and they need a house to live in. So what you've done is you've added all these people, but you haven't added inventory. Okay, and that's what drives the prices upward. So I'll turn it back to you, Ty.
Yeah, perfect. So kind of the same thing goes for the Inland Empire. A little bit less inventory, so to speak, in the Inland Empire that we've seen, not as much as Orange County as you saw in that prior graph, as well as even though prices are going up, and most out there probably think a home in Corona is just astronomical for Corona. It's Orange County prices, right? But at the same time, it is less than Orange County, as we all know. And so it still is a very, very competitive market, even more so in the Inland Empire. And so we're really, we have the resources for our clients, again, whether it's for your personal home or an investment, as far as getting pre-qualified, and in a lot of cases, not even just pre-qualified, but actually getting qualified, so to speak. So when you're going in to make offers on these homes, you stand out up and above those other offers and the competition to secure that property. So I just wanted to mention that as well.
Very important.
All right. And let's see here. Just want to check if we have any questions. And looks like we don't have questions yet, so we'll just keep on moving forward. So now let's talk about a little bit about legislations against you as landlords having rental properties. Now, obviously, this is specifically in California. That is our market. We are not attorneys, so double check all of this, but we did want to share it with you. So really, there's several bills that are proposed, maybe each and every month, more so one month over the other, or you might go a few months without any. But we really wanted to share the main four that have came up here in the recent months. So the first is, it's the bill called AB 2710. All right. Now we put there, think twice before you sell, and you'll see why. So if this bill passed, it would basically require landlords of single family homes or apartment buildings to give notice to qualified entities before placing the home up for sale. Now, a qualified entity, what is that? Well, you'll see there on the screen, it includes what's called a tenant organizations, either a community trust, and as well as affordable housing and nonprofits. So, for example, if you wanted to sell your house and it was a rental property, you would have to go to these organizations or these entities before you could basically put it up for sale on the open market or sell to anyone, even if it was off market, family member, friend, whatever that may look like. Those groups, what the bill would say is that they have the first right of refusal, which again means that you have to go to them first. If they pass on it, that is when you would be able to go on the open market. Also with that is what the bill is saying is that those groups and those qualified entities would actually have at least 1 year to secure the financing for the purchase of your property, which is absolutely asinine, but you know, it is what it is on that. Now, also what they're saying is that those groups, they would have the right to actually contact your current resident and notify them of the sale. Good news is that was actually defeated at the beginning of this month. So everything that I just went over, that does not apply. So again, we're going to go through about 3 more, but I just want to stop here and say it is very important, and we do send this out mainly via email. But when these bills are coming up for voting, is we really urge you as landlords, especially, to go ahead and vote on these, because it is super important, as you can see, just on this one bill, what could have happened. So with that, the second bill we want to share with you is AB 1771. It's basically what would be called an anti-flipping legislation. It would apply to the residential properties. It would exclude apartments when at least 15% of those units are considered affordable housing, is what that bill would say. What it's sharing with us is if you sell a residential property within 3 years of purchasing it, then you will pay a 25% capital gains tax on that. So this is more geared towards flippers, which means if someone bought a home, they renovated it, and they sell it for a profit, you would be taxed a 25% capital gain on that profit that you made within that first 3 years. Also, the penalty, they were saying it would decline by 5% each year until it reaches 0. And they're basically wanting for the tax revenue collected, it would go to what would be called a speculation recapture community reinvestment fund. Basically what that would be is they would disperse it to either local governments, for schools, affordable housing, and all of that. Again, great news. It was defeated. So all of what I just shared with you, not going to happen. So again, going back to please vote on these when you can. It's very simple. We give you all the info to do that. It really helps out, you know, not just us, it's more so for you as the landlord of the property. Third bill I wanted to share is called SB 1324, and it's in regards to debt collection. A lot of this came about because of the pandemic and renters not paying the rent. So we'll go over a couple things here. Basically, SB 1324, what it would do is it would treat unpaid rent from the pandemic as consumer debt, like an unpaid credit card. Any rental debt since basically January of 2019, it would fall under this consumer debt bill. What it would also do is the rental debt would then fall under what's called California's Rosenthal Fair Debt Collection Practices Act. And that law requires that those who actually attempt to collect on that said debt is that they have to follow certain guidelines, certain rules to prevent harassment of the debtor. So of the renter in this case. Again, under this act, you have to register as specifically a debt collector, which doesn't really make sense in total. And there's more information. We've sent out some links on that, and anyone who requests it, we can absolutely send the info out on these websites so you can read up more about it and what that would mean. But also just wanted to say that what they're saying, the contention is this Rothenthal Act. It pertains to credit debt, and rent is not necessarily credit, right? So that's where it kind of gets dicey and confusing in some cases. So this one, it was a partial victory. CAA, which is California Apartment Association, at their request, the bill, it was amended to exclude specifically landlords from registering as a debt collector. So you as landlords, it excludes you. That's the good news. The other thing is, if you were attempting to collect on any unlawful detainer or small claims court actions, those are excluded. Okay. And then one of the last things is the bill in its entirety, it's still moving through the Senate. And so that's why we said we'll definitely keep you updated on that and give any new information that would come out on, again, SB 1324. And lastly, AB 1791. Now you see there are more taxes. So I'll go through a couple things here. What it would require is that all residential units, okay, including rental housing, were to pay an annual excess tax of $500. Basically, the tax would be intended to help out and fund the development of affordable housing. And it would take effect immediately as what they were saying, a tax levy. More on the 1791, it was completely rewritten, and it's discarding the $500 tax levy. It's now attacking what's called, and we've mentioned this act before, the Costa-Hawkins Rental Housing Act. So presently, as it stands, the Costa-Hawkins, it protects housing built after 1995, as well as single-family homes from local rent control ordinances, okay? If this bill were to be passed, because it has been rewritten, it would open the doors to basically corporate-owned single-family homes to local rent control, okay? Also, the bill, it was amended. It's still under review. And again, we'll keep you updated on any new updates on that. So I just want to stop here and check if we have any questions. And it looks like we don't, so we'll just keep trucking forward. So Ron, he's going to talk about inflation as we have in previous ones, and we're going to keep talking about it. So the floor is yours.
Thank you, Ty. Yeah, I wanted to spend just a few minutes on the inflation. In fact, I just cut a video on this because of raising rents and how that plays into the inflation. But just give you a couple numbers. In our research, we found that on repairs, and this comes out of like places like Home Depot and Lowe's, 3 years ago, it went up 2.2%. As far as materials and things that you would buy at Home Depot. Okay, in the last 2 years, it's went up a whopping 39.6%, almost 40% increase. So that means repairs on your property, they're going up. Okay, and gas has gone up. Gas has went up 48%. Okay, and so that is hyperinflation. Okay, and I don't see any end in sight on that with what's going on around the world. So it's just really, really important as far as with an inflation, you got an 8.5%. That's what they say inflation is if you check the news, but really when you look at the things that really matter, you're closer to 35 to 50% as far as increases. Okay, so don't be swayed what you see on TV, because this inflation is real. Okay, it's going to probably be around for a while. And so we want to get ahead of the game. So those of you that are on the call tonight, when it comes to raising your rents, you'll be seeing, and you'll also be able to watch my video on this about raising your rents, because they will be going up significantly. Significantly to us is $250 to $400. Okay, because we've got to get your rent up to where it needs to be in the next 2 years, because they've already tried to pass as far as legislation that would limit the amount you can raise your rent every year. It failed the first time, but have the feeling that it is going to eventually pass. And if it does, then we want to get your rent up to where it needs to be. And so when we send that out to you and you look at it, you might be sticker shock, but keep in mind, labor costs went up, gasoline has went up 48%, supplies have went up 39+%. So that means that your garbage disposals, your hot water heaters and all that, it's going to be a lot more than what you're used to paying. So what we're trying to do is dig the well before we need the water, right? So that's what we're trying to work with you on this here. So, okay, let's go to the next slide there.
Yeah.
Okay. Okay. We're going to talk about a headline tonight as far as having the proper insurance on your property. Now, some of you, if you have your pictures of everybody on the left-hand side, some of this is cut off a little bit. But basically, the first thing you want to make certain that you have in insurance is you want to make sure you have, fire and liability. Okay. You want to make sure you have that insurance there. Okay. And the next thing of it is we want to make sure as far as, in fact, I've got it covered up myself and I can't even see my own slide here. So bear with me. Yeah. I want to talk about the loss of rents or loss of use. Some carriers look at what that is. We just had a property. Okay. It caught on fire and it burnt down. It's going to take about a year. A little bit less to rebuild it. And so in that, the owner is going to get covered on the rebuild under the fire policy. Okay. And the loss of use or loss of rents, as we like to talk about it, is basically they're not going to pay whatever rent you were getting from the resident, you're not going to get from the insurance company, and they'll pay you that up to 1 full year, which normally we've seen in 37 years being in the business is time enough to go through all the paperwork, get it rebuilt and get it re-rented and everything. And so because the owner had the right insurance on this, they're sitting very, very good as far as on this property. So, and that's just happened in the last couple of months. Vandalism, obviously that is somebody that, breaks in, from the outside in. But the next one I want to talk about is malicious intent. And this is where a resident would damage the property. It could be things if they put holes in the wall or they destroyed other things as far as in the property that's major. You'd still have your deductible, but let's say it was $10,000, you pay deductible, then the insurance would come in and pick up some, if not most of all those other damages and things. So you want to make sure in your policy that you definitely have malicious intent. And if you have any questions on this, you can call our offices tomorrow morning and they'll show you what kind of insurance that you need to have. Here's the worst kind of insurance to have on a rental property is homeowner's insurance. Okay. That is not good to have as far as on a rental property. So just make certain that you have the right insurance. This investor, when we took on the property, we made sure he had this insurance. And of course, now when you have the laws, he's very grateful and hey, we're happy to make sure you're protected on your property and stuff. So he's going to end up with pretty much a brand new home and no loss of rent, when it's all said and done. And in the meantime, in the next year is probably going to go up, at least another 10% or another $50,000. So I don't wish a fire on anybody, but if it does happen, we want you to be prepared on it. Okay, let's go to the next slide here. So if there's any questions, answer them. If not, we'll continue to move on here.
Yeah. One of the things I want to mention too on the insurance, because I'm dealing with a lot of new owners that are looking to use our services. And when I go over this with them, when they're looking to go ahead and work with us, one of the big questions is, well, okay, I have my insurance, but what about the renter? So specifically at management 1 is that we require the renters to show proof before they ever step foot in your property of their own renter's insurance. And our standard is that they have a minimum liability in their policy of $300,000 or more. So that's a big question I get a lot. I just wanted to mention that. As far as on your policy, John, he'll be talking a little bit more about that, but as Ron had mentioned, it's not a regular homeowner's insurance. It's a landlord policy or a non-occupant owner policy. And John we'll be able to touch a little bit more on that. So with that, John, welcome.
Thank you very much.
Being on. Yeah.
Yeah. Tyler and Ron, excellent information. Boy, you guys have really done a great job presenting it. I don't know if you need an insurance guy on here because you did such a good job. But yeah, John Peterson, I'm with DFI Insurance. We're located in Corona, and I've been in the business about 20 plus years. I'm a certified insurance counselor and have worked on a lot of different properties. The guys have really touched on some important issues. The first one being the homeowners versus a dwelling fire or a landlord policy. That's very critical, and it happens a lot. We're seeing people that are using mortgage companies, and the mortgage company usually says, hey, we'll take care of your insurance for you. And we all like to avoid having to deal with the insurance. So they let the mortgage company take care of it, and they end up with the wrong policy, or policy that does not fit their needs. So be sure and pay attention to that slide they had up there on the type of policy. Make sure it's got the loss of rents, malicious intent, and the liability is very important. I think the $300,000 that you're recommending there is good. You can buy them with a little bit less coverage, but the $300,000 would be the minimum, I would say. And we can talk about it a little bit later as we get into the insurance, but definitely consider an umbrella policy, which is going to increase your liability and protect you a lot better at a very inexpensive cost.
Yeah. Now let me go on this slide here. As far as an asset protection, there's several vehicles you could use. You could put your properties in a trust, or the next item there on the slide, or you could put it in an LLC. Like with the LLC, the challenge you have in California, you got to pay $800 every year to keep that LLC in force. And so if you got 10 properties, that gets pretty expensive every year. Okay. And so normally people use a trust instead of doing that, if that be the case. Now, the third one, which is actually the easiest one, is insurance. Okay. And what we do on that is we make sure that you have enough in case there's somebody got really maimed, or even worse, if somebody died in the property. Okay. And that has happened. Okay. Over the years with us. And I just want to do a little intro here as far as with one of the attorneys that I've worked with. It wasn't on one of our properties, but he had a client. They elderly couple, about 64 years old, retired, living in their home, free and clear. They had a duplex. It was free and clear. Okay. And the resident got hurt on the property, severely hurt, where basically he was going to be, invalid for the rest of his life. He couldn't work or do hardly anything. And that's actually even worse than death sometimes, because it's an ongoing cost. And at 30 years old, I mean, you've got another 50 years. And so the cost is going to be really, really high, And so on that, what happened, they filed suit. They came in, and he had insurance on the rental property, but it wasn't enough to cover. And he had insurance on his own personal residence, and it wasn't enough to cover. What happened was they ended up, and they took the duplex, they took the house, and they took whatever they had in savings, and the owners ended up living in a 1-bedroom apartment, okay, because they couldn't touch their retirement, okay. But other than that, it just cleaned it. And what it was is they had it in their personal name, okay. And if you're going to have it in your personal name, this is where John comes in, then you got to have the right kind of insurance, and you have to have a major amount of insurance to make sure you're going to be covered. And so with that, I'm going to let John move forward.
Thanks, Ron. Yeah, the best way to protect yourself on the liability side with those big numbers is going to be an umbrella policy. You can buy an umbrella for a low limit of as low as $1 million on up to, most carriers will do 10 million. Some of them will cap it at 5, but 10 million as well is available. I always say umbrellas are probably the most affordable insurance. Most of us know that $1 million or a $5 million claim the odds of that happening are slim. That makes the cost lower, but it can happen. And of course, when it does happen, it's a catastrophic event, like the example that Ron gave. So we highly recommend that you find an agent that's going to work with you and go over these policies, not just a cookie cutter policy you get through a mortgage company. Find an agent that you can work with, and we'll evaluate your policies on a regular basis. And definitely consider an umbrella policy that's going to give you adequate limits for that catastrophic event.
Yeah, and on mine personally, I run 5 million as far as on the properties, and the reason of it is because it's easy to go right through $1 million, especially if somebody was maimed or somebody got killed. And I'm not an insurance broker, so I don't want to be taken that I'm acting as insurance broker, but normally a lot of insurance companies, it normally will pay out 5 million for a death. Okay. But if somebody gets hurt, it could be even more than 5 million because it's ongoing for 10, 20, 30, 40 years. And so insurance seems to be one of the better ways to go. If you have it in a trust, then every time you want to move it or whatever, or you want to refi it or whatever, you got to get it out of that trust and you got to refi it. And it's a lot of stuff going on. I'm not saying not to have it in a trust. I'm just saying whatever you put in your trust, there needs to be that you're probably not going to, you're just going to buy and hold and leave it alone. Okay. You're not going to refi it. You're not going to do any of that. LLCs, again, the challenge there is it could be very expensive. You got 10 properties, $800, that's $8,000 every year. In 10 years, that's 80 grand, and so that's what ends up hurting us as far as in terms of, putting it in an LLC. Now, what you can do is, let's say you want to maneuver a property, you're thinking you're going to sell it in 1 or 2 years. What you can do is, let's say you got 6 properties, you leave 5 in the trust, you pull out the 1 and throw it in an LLC. You could do something like that to maneuver your situation around a little bit. But John, what are some of the things on insurance claims and things like that should people, be aware of, or what could happen?
Yeah. First, I'd say you definitely want to make sure you've got the correct limits of insurance. Of course, in this market with real estate being up, the limits are okay, but a lot of times you look at some of the limits on the policy and you say, well, boy, the house isn't worth that. But recognize that the limit of insurance is specific to the rebuilding cost in that area at that time. So be sure that your agent or broker does a good evaluation on the limit of insurance for the building. We regularly see claims where their limit of insurance was not enough, and that they chose to go with the lower limit, usually because of cost. But the cost on the policy is really not that significant. So make sure you have the right limit. Deductibles. If you have a lot of claims, obviously you're either going to get canceled or have to go to a higher risk company. So we recommend a good solid deductible. Most of us aren't going to turn in a claim for less than, 1,000 or maybe even 2,500. So you might as well go ahead and have that higher deductible because you're not going to turn a claim in on something smaller. So that's important.
Yeah.
And then again, I think just a regular evaluation. A lot of times you write a policy and put it to bed and move on, and take that time to regularly evaluate. Once a year, go over the policy with your agent.
Yeah, and if you guys don't have, I have a lot of insurance with John and his firm, and with business insurance and property insurance and things of that nature. And it's good to be working with a firm that's been around a long time. They've seen the changes and they can keep you updated on things. So, but there's a lot of good insurance companies out there. I think the bigger problem of it is we as individuals, we don't take time to go see our insurance company.
Right.
That's normally the problem. It's like, oh, it's okay, it's been fine. But just like here, the story I just told on the insurance, well, they had no idea that, somebody could come in and take not only the rental property, but their own property that they were living in and stuff them into an apartment. you know,
Mhm.
so, you know, that's not what you want to have. Now, John, also on your insurance, like if somebody owns 5 or 10 properties, you can set up policies on theirs, and let's say 5 million, which is what we recommend as well. Okay.
Mhm.
And you can set it up there that it could be a 5 million on each one of those properties, correct?
Correct. Yep. Set it up to where your each occurrence limit is the same on each property. So even if you have a claim on one,
Right,
you've still got the full 5 million for another occurrence on the other property.
right.
And you
Now, I
can
know a lot
definitely
of,
write the policy that way.
Mhm. Now, I know a lot of you on the call are probably thinking, well, how much does this insurance cost? It's really hard. I mean, it's not as expensive as you think, to be honest with you. Okay, it could be 1,000, it could be 3,000 or whatever, or maybe a little bit more depending on your circumstances. Okay, but the bottom line of it is for what it gives you in coverage and making sure your assets are protected, you know, it's well worth it as far as on it. And basically, you just kind of look at, hey, my house went up 20,000, you know, last year, and I got 3 houses, so I made $60,000. Okay, so you got to spend, let's say, 3,000, you know, to make sure you have that higher coverage. It's well
Mhm.
worth it to make sure that you're going to be in good shape, you know, and with a good carrier. And there's a lot of good carriers out there, you
Mhm.
know.
One other item, Ron, I wanted to touch on was the vacancy issue. I know one of your slides did touch on that, but um, if your property is vacant for more than 30 or 60 days, talk to your agent. There are vacancy clauses in the policy that it reverts to just straight fire and even a reduction in coverage. We just had one recently. The client didn't advise us that they were actually going to be putting I guess, a campaign headquarters in there for somebody that was going to be running. So it was going to be an office in a converted home. And the person ended up not running for office. They never went in there. They had no tenant. And some vandals got in there, homeless got in and started a fire. And so their coverage on the policy was reduced by 15% because of that vacancy situation. And so be aware if you've got some vacant properties to make sure they're insured the right way.
Yeah, minimum should be in your policies. Guys, call your insurance tomorrow, not Friday or not Friday, not Saturday, but tomorrow, and just say, look, you know, what do I have on this? Okay, to make sure it's at least 60 days. And if you have a property that isn't getting re-rented and taken care of, you know, then you want to contact your insurance company and say, oh, hey, what can we do on this? Can we change the policy or whatever? Because I want to be protected. It may cost you a little bit more, but it's going to be well worth it if you should have vandalism, or worse yet, if it caught on fire or something. So a lot of people, be honest with you, I would say even on the call tonight here, most of your rental properties has probably got a 30-day on it. So tomorrow morning, call your insurance agent and ask him, okay, what are my options on this? You know, because even if your house becomes vacant today, by the time it becomes vacant, we do all our inspections. Then we have to have the crews go in and rehab the property. And then we put somebody in there. That can easily be, in this market, we're doing it probably in 30, 40 days. But in a normal market, that could easily be 60, 90 days.
Mhm.
And so you need to make certain if that is there, that you're checking with that insurance carrier. And we know insurance is not a real hot topic, so to say. It's not exciting, you know, is buying properties and making 100 grand and all this kind of stuff. But you know what? Management One is here to protect your assets, not just create assets for you. And that's why I wanted John to come on tonight and to show everybody what we can do. And you see on the screen there, Matt would be the guy that you would actually talk to. He does all the policies as far as on rental homes. And you can also, at the same time, if you're going to look at it and maybe getting a quote, and I would recommend you do that. They're not going to charge you anything, right, John?
That's correct. Yep. No obligation.
Yeah, but get it on your personal resident as well.
Mhm.
And make sure you have the right coverages. That's a big thing. People, and I used to do it too. Haven't done it for years, but I look at what my policies are doing now. Where years ago, I just kind of, yeah, buy it, and you wake up 10 years later and you find out that it's underinsured, you know, and then something catastrophic happens. So we want to make certain that's taken care of. Okay, let's go to the next slide here. And Tyler's going to go ahead and talk a little bit about what's happening in the rental market. We'll probably be on the call here about another 5-7 minutes, everybody. So bear with us. And Tyler, I'll turn it back over to you.
All right, perfect. Lots of good info. So to wrap it up, as we always do, is in terms of specifically on the rental market. As you could probably tell, we're very heavy on graphs and examples, but we do it for you as potential clients or current clients. And so on this, you'll see there it's the annual change in the median rent dates back to 2018 till this year, more specifically April, so about 2 to 3 weeks ago. What it's saying in terms of how the rent rates are growing. And as we all know, and as we've been touching on time and time again, as well as we did this evening, is that rental rates are going up. So for you as landlords, that's a good thing, because as Ron touched on, is that inflation is here to stay, at least for the foreseeable future. Now, you don't have to like it, you don't have to agree with it, but inflation doesn't care if you don't like them or agree with them, because they don't. So we need to keep your rental rates at market value. A lot of times, since I'm on the front lines, for lack of better words, with potential clients that are looking to come with us, I always say, whether you use us, you use a different management company, or you manage the property yourself, you need to be educated to the utmost part in terms of what rental rates are doing in your market. A lot of times I have owners who, especially when managing the property on their own, in most cases, they haven't raised their rent for 3 years, 5 years, 7 years, because they had a good renter. They pay rent on time. They don't necessarily complain about the small repairs. So in the owner's head, they go, okay, well, that's fine. I'll just keep the rent and that's fine. You're trying to be a nice person. We totally get that. At the same time, at Management One, and I know some other companies out there, is we're not gouging these renters. We're just keeping up with the market and what the market is saying. And if your property, let's say it's been rented for the past 3-4 years and you haven't raised your rent, well, now the gap between what the current rental rate is at that you're charging your renter to now what the open market value would be, in some cases, we've seen it as high as over $1,200. And that's per month. So you take $1,200 times 12 months, do the simple math. And as Ron has shared, your costs are going up in terms of if there is a repair on the property. Your cost of living is going up, gas, housing, groceries, everything like that. So, it's really, we're here to educate you as the client and give you our professional expertise and recommendations. So I know there's sometimes, and probably some of you current clients out there might, sometimes not want to raise your rent because you do have a good renter. But as Ron has shared this in the past, and we share a lot, and I share this with a lot of new owners or new clients, the number one reason we've actually found that a renter will move out of a property is because maintenance specifically is not done in a timely manner or not done at all. It is a very, very minuscule number that people will actually move just because you raise their rent. So how does that come full circle? We raise their rents, puts more money in your pocket each month. So when there are repairs and Management One or whoever it is that calls you and needs those repairs done, you can do it and you're not stressed out for that money, which in turn keeps that good renter in your property and continues to raise those rents year over year.
Yeah. Let me ad lib on that a little bit too, because when we do raise your rents, right now, some of them are $250, $400 increases per month. And you might think that is a lot, but some of my friends rent, they just got an $800 a month increase in rent. And it was on, the lady was paying $2,300 a month and they raised it $800. Okay. And she either had to take it and she said, well, I can't pay that. I got to go find something else. She looked around for a week. Everything else was more than $800 than she was paying. And so with us, we're not trying to gouge because they've been good clients, but we've got to get those rents up before legislation should kick in. Then you're going to be caught where you can't raise them. like it was in San Francisco for decades. Okay, and we don't want that to happen to any of you. So it's not uncommon when we have somebody give notice to raise their rent, an easy $500 a month. And in a number of cases, we've rented them over $1,000, and they've rented in less than 72 hours. Okay, so people that are with us, we're going to take it a little bit slower road because they are our clients. But if they went and rented somewhere else, I can guarantee you it's going to be $400 to $500 higher than what we're increasing the rent to. Okay, and we want the money there. And lastly, you know, we want you to make sure that if some of you haven't done this yet, we talk about the piggy bank, but you really need to set up a separate account for your rental property, because when these rents increase, those monies need to be going into that rental checking account. Okay, it cannot go into your personal account. Okay, because when we call you and the people have been there for 8-9 years, and now you need $10,000 to rehab it because you got to put in carpet, you got to be in paint and some landscaping. You want to have the money there in that separate account. So you need to look at that as an IRA, that you don't touch that money. Okay, and if you take that lead with me, you're going to be very happy when we call and you need a repair done, because prices have already changed. Simple things like hot water heaters, garbage disposals, all that kind of stuff is just gone through the roof. And so you're going to see some major changes if you haven't already. So we're basically going to dig the well before we need the water. And that's what we're, you know, working with everybody on here.
Yeah.
Tyler, I'll give it back to you.
Yeah. So real quick, and then we'll see if we have any questions before we wrap it up a little bit early here this evening. So another graph. But what this one is in terms of what they're saying, the vacancy index. So this dates back to the year 2019 till this year, so about 3 years prior. And what you'll see there is where you see the dotted lines and it kind of goes a little bit gray. That's when the pandemic hit. So March, April of 2020. As far as if you look in 2019, in April, it was 6.4%. You go to April of 2020, that's at 7.1. You go down the line there and you'll see as of this year, you know, we're somewhere right around the 4 to 4.5, maybe slightly higher than that. But what we're really seeing in the marketplace is we're having very minimal vacancies. And it's because of what Ron touched on in terms of when raising rents is when we do raise the rents on your property for you, and the renter might not agree with it. So they say, well, if you know, I can't pay that, or they don't want to, whatever the case may be. On our side as management, we actually educate your renter, and we give them data to say, okay, Mr. or Mrs. Renter, go look on the open market for the same property in a comparable neighborhood. Go look on the Zillows of the world, all of that online, and see what those properties are renting for. And you know, our leasing team could speak to this, but more times than not, they actually just come back and typically agree to the rent increase, because it is more expensive than going to find something else, which in turn, when they stay in the property, it lowers your vacancy.
Let me add lib on that too, Tyler, because what we've started doing as well, this information I've given you tonight, like, you know, increase in costs at Home Depot, 39% plus. Okay, labor costs from the contractors is up, fuel is higher. Okay, we let residents know that. So they need to know that if we don't raise the rent, then when you have a repair, the owner can't repair it. Okay, right. Otherwise they'd have to come out of pocket. And so it's not good for anybody, but it's not because they're trying to gouge anybody as far as on the rent. They're trying to make it so they can offset and take care of the property and improve the property, not just do repairs, but we encourage owners to improve the property along the way, you know, and so they take care of their property. So in 40 years, that house right. or that property still looks nice, you know, and it has value. It's not run down and you need a new roof and all these types of things. So just understand where the market is, and these numbers are pretty true. The fact. Okay. All right. Back to you, Tom.
Yeah. just want to, so before we wrap up, I did want to see if there were any questions. And we do have one. So they were asking basically the rules on the rental cap. You know, a lot of people might have been told or seen that it's 5% of your current rent if it's the same renter, plus inflation or CPI, depending on where it's at. So, you know, round numbers, let's call it 10% total of that rent would kind of be the cap. They were asking if that's correct. So Ron, if you want to touch on that, and I can as well.
If you give out 90-day notice, okay, as far as on it, okay, then that gets you around any caps that are out there as far as on the rental properties and stuff. And so that's what we've started doing, because if we only raise it 10%, you know, it's going to take 10 years to get you up to where you need to be, and it doesn't go fast enough. So, and we do have some properties that we're only raising $75 to $100 a month because they're already at the top of the market. So the owners of these properties, they don't want anything more than what the market is. They're not trying to say what the market is, $3,000 a month and they want $4,000. That's not it at all. Okay. But they want to make certain that, you know, that they can go ahead and take care of things, you know, when things break, and they will break eventually. Yeah. Okay. Right. And so we just, you know, like I said, we got to make sure our owners have the money so they can, you know, take care of the property. Management, one, probably more than a lot of management companies, we're a stickler on making sure properties are taken care of. You know, a lot of you on the call here, you probably know, we call our residents every other month to check in to see how they're doing for the life that they stay there. So somebody stays there for 29 years, which we have residents that have been in some of our homes for 29 years, they get called every other month for life. Okay, because we want to check in and see how they're doing. As a lot of you know, as owners, we also call you every other month. Okay, and check in as far as with our owners. And then we have a third thing with, after every work order, we have an outside source that calls and checks and rates us on how we did on getting the repair done timely, was it done thorough, et cetera, et cetera. Those three things right there is huge as far as in terms of building relationships with your residents, you know, and with yourselves.
Right. Yeah. And I just want to add a couple things. So going back to the rent cap. So yeah, as Ron said, we do the 90-day notice, which by law, you have to do that to get around the 10% cap. The other thing though, is it does depend on how your property is held in terms of on title and the deed. What I mean by that is if you have your property solely under your name or you and your partner's name, again, call John, get the right insurance. But you can, in that case, you are able to raise the rent more than 10% with that 90-day notice. Where it becomes of the rent caps is specifically if the property is held in a corporation or an LLC. That is where, in most cases, you aren't really able to. So that's the only other thing as far as what we touched on earlier, holding your property in an LLC, you know, $800 a year. Also with the rent caps, you fall under that in most cases. But yeah, if anyone has any more specific questions, definitely reach out to us on that. We double check fact everything with our attorneys. And so all this data that we're sharing with you, that's, you know, what we're getting from our attorneys relaying that info as well. And then the last thing, and then we'll wrap up here, coming up to the top of the hour. Going back to what Ron mentioned on how we're calling you as the owners every month, or every other month, I should say, as well as your renter and the property every other month. Really, and I think Ron could attest to this too, even more so than myself, but especially calling your resident every other month, what that really does for you, and you'll see there on the slide, is one, lowers your vacancy. We are a relationship-based company. We are not transactional. Just because we rent them the property and they go into your home, they're paying rent on time, we want to create that relationship with them. That's one of the first things. So it lowers that vacancy typically. But one of the most important and probably the biggest thing, and when we started implementing this a few years back, is it really helps the preventative maintenance of your property. What I mean by that is life gets in the way. Whether you rent a home, you own a home, whatever business or job you're in, life gets in the way. And what we found is when we first started calling your resident is, oh, yes, I meant to call you guys, 6 months ago because of this, that, and the other to the property that we thought needed repaired. So what it's doing is it's helping that preventative maintenance of your property, that we're getting to the issue at hand, so to speak, quicker, which not only helps your property, the value, not having a smaller issue, basically become a bigger issue, but then coming full circle again and lowering your vacancy.
Okay. All right, let's go to the next slide, Tyler, and I think we'll wrap it up here.
So next month, in July, so every other month we're doing these, so 6 times per year. So in about 60 days from now, on July 20th, again at 6 p.m. Pacific Standard Time, we will have our next webinar. We'll be getting all of you details in terms of what it is going to be about. And on that, we should have our normal hosts and panelists on that in terms of Chrissia and Kristen as well. So with that, again, if anyone has any questions, please reach out to myself. You could also reach out to Chrissia as far as if you're looking for properties in the Inland Empire. But with that said, John, we really appreciate your time, and Ron, you as well, and everyone else on the call. We really appreciate it. Really helps us out. We appreciate the support, and we always appreciate your business. So if we can help in any way, let us know. With that, gentlemen, if you have anything else.
No, thank you, everybody.